is a distinguished marketeer working with one of our member companies. That is ICA Lion Assurance Company Limited. And he has been in the industry for quite some time, close to 15 years. And he has been able to grow the agents force under this company up to from a few members he began with to around a force of close to 700 agents, and as well as growing the company's sales force to be one of the best in the industry. Is a distinguished marketeer and has some insightful knowledge about what insurance is, what it does, but as well as also good ideas and good knowledge on savings and investments, which is going to take us through. And thereafter, we shall invite questions from the public. But bear in mind that also we, as the Uganda Insurance Association or the insurance fraternity, we are a member body that also deals in products ranging from insurance as well as also savings and investments. Ladies and gentlemen, welcome to this session. And I think we are ready to go and we can be able to begin. Once again, welcome. And before we begin, I think we shall have a few questions which will be coming your way. We would want to hear from you to know the people we are having in this webinar. And a question is before you there, would want you to fill and answer those questions so that we can get a feel of the participants and the audience of this participation before we can go in and then be able to share with you what we have shared with you. So ladies and gentlemen, the poll question has already been broadcasted, so you feel free to answer before we can begin our session. So in here, we are looking at the age groups of the people who are participating in this webinar, for us to get a feel and also to know what products might be tailored or what products you might need to know about savings, about insurance from our members. So there are 8 questions there. Once you have selected, you submit, and then once we have got that, we shall go through the questions and the answers before we can have our discussion with the presenter, with the main panelists. So for members who have just joined in, there's a poll question there. You can just answer those questions. We just need to get a feel of the audience we are having before we can have our session with our panelists. Yes, there we go. Thanks for your participation. I see the age group is largely below 30. 33 of our participants here are below 30 years. And okay, the large in our population which is attending this webinar is between 30 to 50 years, which is a good age group for us to provide this information with, because you are in your peak years to do your savings, to do your early retirement planning, which also our members, as shall be shown in the slides, can provide. So it's good to know that even insurance companies can do retirement planning since we are in our peak years. And even for people who are below 30 years, it's not too late to start planning your retirement, because day by day, you're aging closer to your old age. And it's good to have a plan in force for you to ensure stability of your finances, even at a time when you are not able to earn. Most of us are employed in the private sector, which is good. And if you are employed, but also we have rolled out plans for targeting people who are in self-employment and the informal sector. It's good, and it's quite important for us to note that 67 or 70% of the people who are in this audience have ever bought insurance, which is quite commendable. And I know some of you have had challenges with insurance. We are here for you as Uganda Insurance Association. We take note of your complaints, and if you have any issue concerning the product you have ever bought, any issue concerning interpretation of the kind of contract that you have with an insurance company, or even issues to do with claims or settlement of your benefits, we are always ready to help. We, the Secretariat, we can be able to push through and then address some of those concerns. And it's also quite important for us to note that almost all of us have ever bought a savings policy or an investment policy, maybe from a bank. For those who have bought from insurance company, that's good enough. But also it's important to know that you can equally buy these savings products, not only from banks and other institutionalized companies, but also from insurance companies, because we equally provide those savings products. Yes, also I see 70% of us have enough information about insurance and saving. But you know, educating and learning is a continuous process. Maybe at the end of this webinar, you will be able to know that there are other aspects of insurance which can provide as well as protect you, not only protect you, but as well as also providing savings for you. This question, which was saying that do you have any plans to take on insurance product or investment? It's good to note as well that almost all of you are interested in or have already taken up insurance products, which is quite commendable. But I think also equally, most of you have heard people complain about insurance, how insurance is this, how insurance is that. Now, this is the reason why we are here. We are here to tell you that insurance really exists, insurance space. And if you have any challenges with insurance, if you have any challenges with any insurance company, any challenges with the product, you can always reach out to us, and we shall be able to help you out and see how we can address any of your challenges. We at the Insurance Secretariat, we address those concerns, but as well as also pushing publicity about insurance companies. Question 7 said that have you ever attended any insurance savings and investment training? Almost all of us have attended, which is also quite good. But I know most of us know friends who have never attended. Always let them know that insurance really exists to help protect and grow your savings. And we have attended this webinar through our employers, most of us. If you have attended through other related associations and organizations, it's quite good to note that you are quite enthusiastic about insurance, and we think you are going to be good ambassadors of insurance services in the country. Once again, let me not take much of your time. I'm going to allow you be able to have a presentation from our panelists. Like I said, this person is distinguished, is well knowledgeable about savings products, and he's from one of our members, that is ICA Lion Assurance Company of Uganda, and we'll be able to take us through some of these products. Ladies and gentlemen, welcome once again to this webinar, and I think Mr. Michael Cowley should be ready to start your presentation. He will introduce himself, and he can at the end maybe leave you with his contact if you need to know more of what he has talked about and what insurance can do for you in terms of growing your savings, in terms of doing your early retirement planning, and as well as giving you the much needed protection against other risks like death and disability. Ladies and gentlemen, welcome once again to Mr. Michael Cowley from ICA Lion Assurance Company of Uganda.
Thank you so much, Badru. It's a pleasure to be here and to present to the great people of this nation who have shown cause and interest of understanding what insurance can offer in line with savings, in line with investment, and also in line with the insurance itself. So my name is Michael Cowley, as I've been introduced. I've been in this industry for the last 16 years now, and have no regrets being here, especially have no regrets in sharing information and educating the public about the importance of insurance. And when this opportunity presented itself, I realized that this is what I'm supposed to do, and I was actually ready. So I'm very happy to be here, and we're going to share quite a bit of information. Of course, this is not the end of learning about insurance. There's so many other things that you'll be able to learn in the due course, because there are so many seasons that are going to be coming up through the UIA and other institutions to train the public about insurance. There are so many other opportunities that will come in. So this is one of them. And I'm here to talk about the importance of insurance as far as the aspect of saving is concerned, the aspect of investment, and also the aspect of protection in this way. So there are various products that we're going to touch base on. And these products are products that are available with all the members of Uganda Insurance Association. And when you have a time to reach any of our members, you'll be advised further and will be helped in case you are interested in taking up the insurance. Let me now share my screen so that the presentation can kick off. Thank you. Thank you so much. So we're going to talk about the life assurance in terms of the investment planning, in terms of the saving planning, and the general understanding of how insurance can as well be linked with banking, and how bank institutions can as well be able to engage in selling insurance. And the reason why the Institute looked at this, and the Uganda Institute of Bankers and Financial Advisor Services looked at that, is that there are so many opportunities for every individual in this country to reach out and learn what is around them in terms of saving. Is it only through the banks? Is it only through the insurance? Is there a link between insurance and banks about investment? So whatever we're going to share today, there's a very good relationship between what our other institutions do in terms of banking and what we do. So when you are in the bank, you can as well be able to get a life product. When you come to insurance, you can be advised about the banking institutes and all the savings in there. So today we are simply going to talk about what we can be able to offer as insurance, and what you can be able to learn from here and what you can take from here as far as your retirement, as far as your planning for your families are concerned, and as far as growing your wealth is concerned. Uganda Insurance Association, it was founded in 1965, as you can see on the screen, with an intention of developing and expanding sound insurance and reinsurance activities. And when you look at the values, and I would like to majorly focus on the last two, cooperation and innovation. Cooperation is that as an institute, the intention is to ensure that insurance companies work together hand in hand to ensure that we spread the right gospel about insurance, we spread awareness and ensure that our people get the information that they deserve to have and know the choices that they have to make about their lives as far as insurance is concerned. And in innovation, we speak about coming up with various products that will actually be able to fit the need of our people in our country. So all the time, there are various platforms created to come up with different products that can fit the need of our people in our communities and in our country at large. So every product, the product we're going to be able to learn today, that's not the end of it. There will always be more products that are going to be created. And this depends on the need that we identify after doing surveys and making analyses. So these are things that we do to fit into the values of the Uganda Insurance Association. The members are quite a number of these life assurance companies. As you can see, we have the CIC Africa Life Assurance, we have the Grand Micro Insurance, we have the ICL Life Assurance Company Limited, we have the Liberty Life Assurance Uganda Limited, Metropolitan Uganda Limited, NIC Life Assurance, Prudential Uganda Limited, Sanlam Life Assurance, Jubilee Life Insurance Company of Uganda, UAP Old Mutual Life Assurance Uganda Limited, and Age Micro Insurance Limited. Now, these are the members under the Uganda Insurance Association, and these members provide the product that I'm going to share today. So any of them where you feel comfortable, you can always reach out to them and you'll be served accordingly. You'll be advised, you'll be led well, and you'll be able to make the right choice as far as your plan, as far as insurance is concerned. This is how where you can find the Uganda Insurance Association, plot 24A Acacia Avenue in Kololo. Those are the numbers that you can be able to use to reach them. You can also be able to tweet, and you can also visit the website and the Facebook and be able to get or interact with the association for any queries, for any inquiries. These are things that are going to be able to get from the association through these various addresses. Today we are going to talk about 6 aspects. We're going to speak about the importance of life insurance. In brief, we shall also talk about the investment aspect in life insurance. We shall talk about the saving aspect in life insurance, the relationship between life insurance and banks, life insurance policies which can be sold by the bank, and also taking up a life insurance policy as a choice or as a prudent decision. So these are the key things that we're going to talk about. And we'll also be expecting some questions through the chat, and then we can now be able to answer them and be able to meet the need and the reasons why you joined this webinar. Life insurance in its way is a way of life where you should be able to look ahead beyond where you are. And when you talk about looking ahead, there are various things that we want to get as advantages of planning ahead of life, of thinking about legacies, of thinking about where we want to go. So you're going to realize that it will give you a peace of mind. You're also going to find that you're going to have an advantage on tax savings. It will help you deal with debt. Insurance will also help you to supplement on your retirement goals. It will also help you to become a source of saving, as we can see, and we shall see more on that. It will help you achieve your long-term goals, and it also helps you provide estate liquidity and equalize inheritance. That one shall elaborate. It will also help you to realize how your long-term or your long-term healthcare and chronic illness can be dealt with. Here we talk about a few things to do with medical insurance, where we shan't go into too much detail about that, but you realize that when you plan well about using life insurance, you'll have a peace of mind, because most of the things that will be disturbing as you grow older are things that you can plan for now through life insurance. And the moment you plan for them, then at that point, you'll have a peace of mind, because everything will simply be falling into place. And when you save, remember the savings and the returns via life insurance are tax exempted, so you'll have a tax saving advantage. You also talk about dealing with debt. We shall touch base into some of the policies which deal with loans, which deal with mortgages and the like. And now those are long-term debts that you can be able to sort using one of the life insurance products that we shall be able to share. Now you have to set your retirement goals. I know some of you are already contributing to NSSF, but remember, you must be able to supplement this, because to protect your social life, there's a great need for you to have really a very founded base in terms of finances to open up projects that you'll be able to run from your active labor. It can also be a source of saving, like we say, so you can choose to save. And the difference with the saving with insurance and other saving drives is that in insurance, when you save, you have to lock in the money for a given period of time so that you can be able to achieve the long-term goal that you intend to achieve. So there will be liquidity as you grow, and as a person, you'll be able to establish liquidity and have something to leave to your people in the event that you have kicked the bucket or you're no longer part of this this planet. So, and also as you grow, you need to really plan for your medical, because remember, when you're employed, most of the organization will provide you medical insurance, but when you're retired or you are out of active labor and you're going to do your own businesses, you still require to have medical insurance. Now, this can be used, the saving through life insurance can be used to purchase the medical insurance to take care of your health care as you grow older for any chronic illness that you can actually encounter. We realize that when you do life insurance, you're going to realize that the premiums paid for life cover accumulate a cash value of about 2 to 3% of the cover. And this is on the cover value of the policy. When you speak about the cover value, in insurance, you basically have to have an anticipated amount of money that you want to work towards. We call that sum assured. Now, this amount of money is the cover value of your insurance. That means this is what goes to your family in the event a risk insured occurs. Now, this money does not sit dormant with us. We actually invest it and we give you a return of about 2 to 3% or more on the cover value every year that your policy leaves. So every year that you leave on your policy, there's a return on these particular monies. There's also returns on life policies. The returns on life policies are tax exempted, like I explained. When you have a cover value amount, call it sum assured, this amount of money, as you have anticipated, it will be growing, of course, with the inclusion of bonuses, like I explained in point number 1 of 2 to 3% or more. But this money will be tax exempted, so there will be no taxes charged on this amounts of money at your policy maturity or at the point when you are deemed fit to be earning this money. You can access low interest loans, some of the life policies. Of course, I know that most of the people, they go into banks to get loans, but some insurance companies and most of the products that we have under life insurance, you can be able to access what we call policy loans, and which are payable at low interest rates, and may not require collateral security. You use your policy as your collateral security. Some endowment life policies, I will explain endowment at a later stage, will give you access to cash value of your policy before the maturity. When you speak about maturity, when you take up a life policy, it runs between 5 to 10, 20, and 25 years. So there are policies, there are some policies under the endowment life assurances where you can be able to access part of the cover value or the cash value of your policy prior to the policy maturity or prior to the expiration of the 10, the 15, or the 25 years of your policy. So now this enables you, of course, to do other small investments while you wait for the policy to mature. The beauty of it is that even when a risk occurs to you and some matters go to your family will still receive 100% of the cover value of your policy. Life policies also give life assured. Now the person is assured, we term them as the lives assured, between 60 to 100% of death benefit at policy maturity. Some policies where you will be able to achieve some partial maturities probably will not give you 100% at the end of the policy term. Others will give you 100%. So it depends on the needs that you have presented to the insurance provider. You'll be able to pick the right product that will fit the need, and that will be able to explain to you whether you'll be able to receive a 60% of policy maturity after receiving partial, or to receive 100% of the policy benefits at the end of the policy term. Life insurance also provides the purchase of annuity. When we speak about annuity, we speak about something that you can be able to use as a source of income when you're retired. You know, when you retire, it means you're not working for that organization, but you're used to an income inflow every month. So when you have a life policy which could mature at the point of your retirement, it can be used to purchase an annuity, which I will explain at a later stage, and that can be able to give you an ongoing kind of salary as you leave. You can also easily clear your loans. For example, mortgage, if you have taken a property on mortgage through a bank or in a financier, this can as well be one of the solutions to clear this mortgage, so that if anything happens to you in terms of death or incapacitation, your family won't be deprived of the right of that property. The investment aspect, that's the investment aspect of the life insurance. And now we go to the saving aspect. The premiums paid for life insurance is later paid out in lump sum amounts, either to before maturity of the policy, that is the event that the risk insured happens prior to the end of the policy period that you selected. These monies can come to you in a lump sum, and now you'll have saved this money. If you look at the normal saving, if you do not have a lot of discipline, it might be difficult for you to save money for a goal of about 10 to 8 years. So under this insurance, you are obliged to lock in this money up to a given period of time to achieve that goal. So when that policy period elapses, you'll be able to receive these lump sums, and now you can be able to fulfill your goal or to achieve the dream plan that you had set up. Also under the saving aspect, life insurance is the master of long-term savings for setting up goals to achieve goals in future. So you want to set up a family business in future, this is the master, because you won't touch this money until such a period set has reached. So this will teach you a discipline. This will teach you a discipline of living at a low cost, but also looking ahead for the things that you want to achieve for your family or even yourself for future. Maybe you want to have a dream wedding, maybe you want to buy a dream car, maybe you want to travel to a dream destination in a given number of years. This is something that you can be able to take and be able to help you reach that expectation. Also, the premium paid under life insurance cannot be accessed, that's what I've just explained, prior to policy maturity, which keeps your dream alive while getting returns. And when you speak about getting returns, most of the life insurance products, they participate in bonus, and every year you'll be able to have a declared bonus, that is a bonus on the first value of your policy. So it will be giving you returns. So long-term, kept in there and accessible until maturity, but gaining returns. So by the time the policy period ends for which you took the policy, the first value, which is the sum assured, will have grown to a significant figure for you to be able to achieve your goals. Also, the saving aspect of life insurance teaches you the discipline of endurance, living at a low cost, not to become extravagant with your money. So we normally have sessions where we train people to save much money for the great future that they want to live. And then they learn to live within low means to avoid a misallocation of your funds, and then you fail maybe to even account for it. Some of the things that we shall talk about again include education security. You have a child, you want them to go to a particular school, institution, or university at that, and this dream is living within you, but you need to have funds available for such. So education is one of the things that we shall be able to pick from in this aspect that we're going to discuss, how you can be able to secure that education and make sure that your child does not end up deprived of the right to go to school or to join an institution or to study a course that they have in their dreams. So when you are now working and you are getting your salary and you are enjoying so many things in life, you have these dreams that you want to achieve in a given period of years. And one of them could be the educational security of your child. Now, if this is the case, life insurance and education security will enable you plan for these children, will enable you save for these children even prior to them starting school. And then by the time they start school or by the time they reach a certain level of education that you're anticipating, money for tuition will be available. So there will be no hassles of mortgaging your property for a loan of school fees. There will be no rushing in terms of how can I now be able to get money for university. Maybe you sell your land. You won't have to do that because you'll have planned in advance and you'll be able to manage that. So those are the key things under savings and the benefits that you will have under savings. The relationship between insurance and banking, we realize that both banks and insurance companies are really financial intermediaries, much as their functions differ. So you realize that the risk involved in banking, I know banks do not carry liability. So for them, they will give you a loan, they will give you a mortgage, they will give you a school fees loan, they give so many other loans there in addition to saving your money in there. But when they give a loan, they must be able to run to an insurance company to ensure that this loan is insured. And also to ensure that the person who has taken the loan gets to understand that they need to insure their lives in the event that they happen to pass on before clearing the loan. Then the insurer will walk in there and clear all these loan outstandings, and then everyone is going to remain happy. So working hand in hand, which is a cooperation that we saw in the values of the Uganda Insurance Association, we work together with banks to ensure that the clientele under the banks get to know about the provision of insurance and what insurance can do for them through the banking services that they receive. Also, banks can work as intermediaries for insurance companies through bank insurance relationships that have now come up, an aspect that provides income for both institutions. So bank insurance is when the insurance products are sold through the bank. Now, a bank is a very reputable organization or institute. It wouldn't really associate with an insurance company if the insurance industry itself is not reputable. So we ride on the reputation of the banks and they ride on the reputation of the insurance companies to ensure that we serve the public in both lines, getting the banking services, but also getting the insurance services that collaborate with the services that are offered by the bank. Also, banks create benefit accounts for their customers by riding on insurance coverage offered by life insurance companies. You have heard about school fees accounts in the banks where there are some assurances given by the bank. These assurances given by the bank because of the backbone of the life insurance companies that are under the Uganda Insurance Association. So this relationship has made it easy for us to collaborate and create awareness to the public about what we can offer and what banks can offer. So when you go into any financial institution, there's a relationship between what they do and what insurance can actually offer. Also, insurance companies as well can ride on the bank's reputation gained over the years by ensuring that their clientele through various insurance risks associated with the type of business they do with the bank is worked on by the insurance companies. So we talked about mortgage, we talked about loans, we talked about other aspects in terms of future plans, in terms of liquidity of businesses and the like. All these things that are offered by the banks are also offered by the insurance companies through the coverage that we provide in the event. Because if you have taken a loan in the bank and you have been able to put in your property as a security, then you are under obligation to ensure that your life is under insurance, to ensure that if a risk like death occur to you, your family won't lose out on the property. The insurer will come in and ensure that this property is the loan is cleared, the outstanding loan is cleared with the bank, and therefore you will be able to have the property for the family. So the introduction of bank insurance in the Uganda market has hence brought and nurtured this relationship with banks and insurance companies even more, and both sectors are bound to grow as a result. And the way that we are going to grow is by creating opportunities of awareness and ensuring that we go out there just like now to talk to the public about the importance of the existence of these institutions, but also the importance of understanding what life insurance is all about and what is in there for you for this particular one. Now, we go straight into the products that can be sold through the bank, and also those that you can reach out directly to the insurance companies that are under the Uganda Insurance Association. We have what called the endowment policies. These are insurance policies which double as investment and saving. They pay out a lump sum at a maturity of the specified number of years or upon occurrence of the insured event. Now, when you take up an endowment policy, you have a goal. And this goal, you've set a period for which you want to achieve this goal. Talk about 10 years, talk about 15 years. That could be the period that you've set to achieve this goal. Now, as you are planning and setting through the insurance company, you have also looked at the first value, called the sum assured, the amount, talk about 50 million, 20 million, 100 million. That could be the target amount that you want to get at the end of the period, 10 years, 15, that will enable you start off your project. Now, along the way, anything can happen. Anything can happen. So when we speak about a lump sum at maturity, now we're looking at a person who has lived the entire period of assurance, 10 years. 15 years, and today is the anniversary of your 10th year of saving through the endowment policy with a life assurance company. Now, when that happens, the first value or the sum assured is paid to you in a lump sum, and then you get it, and you can now be able to start your dream project. That is something that you can achieve under any of the endowment policies offered by the life insurance companies or insurance companies in the country. Also the life assured, now this is the person who has now taken up a life policy, has an obligation to pay a specified amount of money. And this, we call it a premium, of which a specific portion is used to purchase a life insurance component, and then the rest is invested. So when you look at the premium that is contributed, which is the money that is charged of the life assured or the client every month, it could be monthly, it could be quarterly, it could be annual, or it could be annual, depending on your ability. Now, this money is what you are obliged to pay regularly for the period that is stated as your cover period. Now, when a risk occurs to you prior to completing the 10, the 15, the 20 years, the life insurance company will come in and pay the lump sum of the sum assured. But if you have also survived the period of assurance and nothing has happened, it also comes in to pay the maturity benefits of your policy. Now, you must be very religious in paying your premiums. You must be very honorable so that your contract does not become null and void. So what keeps the contract alive between the life assured and the insurance company is the regular contribution of the specific premium that was defined at the inception of the policy. So you have an obligation, just like the insurer has an obligation to fulfill the need and to keep creating awareness and encouraging you and enhancing your understanding of the product that you took and the benefits thereon. Some endowments are anticipated in nature and design. And these are endowments with guaranteed cash payments. We normally call them the 3 payment plan programs payable to the policy owner or the assured at regular intervals during the policy term. What do I mean here? You might find that some of the life insurance companies have what we call the anticipated endowment policies, where you are able to access part of the money of your policy before the policy matures and without occurrence of the risk, to enable you be able to enhance a project, probably that is running already, but also to help you meet a few needs that are available and current as your policy continues to run. The beauty about this product as well is that while this is happening and you are receiving these special maturities, your family, who are the beneficiaries on your policy, they remain covered at 100% cash value, or rather face value of your policy as defined at inception. This can only change, and go back to what I said, you can receive the 60% or 100% of your benefits at the end of the policy. So if you survive the risks for the period of assurance, let's say 10 years, that's when you receive a portion or a certain percentage between 60 or 65 of your policy, because you will have achieved part of these monies along the way. We also have the education policies. Education is one of the most challenging aspects we know in life, where it is one of the greatest gifts a parent can give to their children. But also we know it's one of the the greatest dilemmas which most people face, because either you've lost a job, or the parents die prior, or they suffer an incapacitation, they get involved in an accident, and then maybe they get a critical illness. A lot of things can happen in there. And when they happen, now the dream education of the child is hindered. The child won't be able to get the kind of education that you have as a dream, as a parent. So what do we do under life assurance? We realize, like I told you, we make analysis, we do research and look for the need, the clear and present need of the public, and then we come up with a viable product. So we have education policies, and they are designed to ensure that continuity of education of a child whose parents may die or suffer permanent and total disabilities and critical illness, hence affecting the education continuity. So what we do is to ensure that there's continuity of education of this child, even when their parents have passed on or have suffered permanent and total disablements, which actually will stop them from getting involved in their daily work to achieve money to pay school fees. So these products are designed to ensure that these children are not deprived of the education right. These policies are also meant to give responsible parents or guardians a peace of mind through securing the education of their children. This doesn't mean that, actually this means that a parent does not need to die for them to enjoy the benefit of the education insurance policies. No, you have to enjoy the peace of mind. Imagine you took a policy for your child is going to join university in the next 10 years, and you buy a policy today to ensure that this tuition is available that time. Okay, whether you are here, that is probably death, or death has not taken you up, or you are not here, or let's say death has taken you up. So let's look at a scenario where you have not suffered the consequence of life. No death, no disability, no critical illness. You are alive and kicking, very healthy. 10 years have lapsed. You have been religiously paying your premiums every month under your education policy with the life insurance company of your choice. Now, when the 10 years lapse, that's when you're going to realize the beauty and the understanding of the word peace of mind. Because school fees or tuition of your child is going to be paid until when your child completes that level of education that you anticipated at the inception, without you bothering whether you have a job, whether there is businesses closed up and the like. So imagine yourself compared to a parent who did have this in plan. The 10 years have lapsed. They have grown, maybe they are retired. The money they have is maybe to ensure that they protect their social security. They have to start a family business that's not yet picked up well, so they cannot get money from it and pay school fees. Or if they get money from it, then now they won't be able to finish the course the child has taken because the business cannot sustain it. That is the struggle that you have to overcome, and that's the peace of mind that you have to get when you buy the education policy. So the cover normally runs between 5 to 20 years, and this depends on the parent's choice in terms of what level of education are you anticipating, because you may find that for you, okay, you are saying, I can, when it comes to primary education, right from now, I'm okay, but my worry is secondary education. So you anticipate when is the child going to join secondary, and when is the child probably is going to join the university. Now, under that situation, that is when you have to make a decision. What level or what term of policy are you taking for a child for a given level of education that you're anticipating? And that is education assurance that we provide under life insurance. Now, we also have the mortgage protection insurance, and this is a type of insurance which is designed to pay off the mortgage if the mortgagor were to die or become permanently disabled. Now, when you go to the bank, you can be able to secure a property on loan. It's a mortgage. You get it on mortgage. The bank will go out of its way to pay the owner of that property, and they buy it for you. So you start using the property and you are owning this property with the bank. So when you buy this property, you have an intention of leaving it to your family in the event that you're not here. It's part of the inheritance that you're actually building. So banks, because for them, they do not carry liability, they expect you to have a plan to ensure that this loan or this mortgage is paid for the period specified. And now that's when insurance comes in. A prudent mortgager should be able to buy a mortgage protection insurance from one of the insurance companies under the Uganda Insurers Association. what does this do? This mortgage protection insurance will protect you who has taken the mortgage and your family from losing the property in the event that you die or suffer a permanent total disability before paying off that loan to the bank. That is something that I need you to know. So in that aspect, the life insurance company is obliged to pay the bank or the lender the outstanding loan on the mortgage that you took at the point of death or disability of the borrower. So when you take a mortgage of 10 years and you die in the fourth year, excuse me, my battery was running low. You die in the fourth year. This means that if you do not have a mortgage protection insurance against your life, the bank will have to sell off this property so that it can recover its finances. And you can say the banks are bad. It's not, that's their business. When you take a loan, you have an obligation to clear it. But if you're a prudent borrower and you took a mortgage protection insurance, we would come in as insurance companies. So your insurer will come in to clear the outstanding loan so that your family are not deprived of the right of this property. So that's what the mortgage protection insurance does. And that, I think, can clearly show you the importance of life insurance and this particular product that I'm discussing. This cover will also protect your family or your partners. Probably this could be a property in a business partnership, from losing the ownership of this property to the bank or the financier, because a bank selling a property because you have failed to pay the loan, it is a prudent thing that they do, and it is within the laws, because when you take a loan, you have an obligation to pay it. So because you know that you are not immortal, anything can happen to you. So it's prudent for you to buy a mortgage protection policy to protect yourself for the unforeseen circumstances like death or disability. This policy also will protect the mortgagee, who is the lender, from battling to find the right buyers of the mortgage in order to recover their money. So when this product is bought, and that's why it will also be ideal for the banker to educate their borrower, the guy who's taking the mortgage, to ensure that they have a cover on the property against their lives, so that if anything happens, they don't lose their property. And also the bank is not under obligation to sell the property. Now they struggle to look for who will buy. Normally they sell these properties at low cost because, I mean, they will need to recover their money and invest. And now you brand them thieves. So it is because there's a bit of irresponsibility or lack of information, which we are doing right now as the Uganda Insurance Association and the Uganda Institute of Bankers and Financial Services. Now, this collaboration is to enable people or public understand how you can work, how you can live your life without a lot of worries on the issues that you can be able to manage with the income that you have, but also to ensure that you can continue to grow with your income and you get big things based on the income that you have, and you are protected, and these things that you're working for are not lost. Remember, there are things you can only achieve when you have a big loan or a loan. Maybe you want an investment, you want to start a business, and you need a loan. With your salary only, you cannot be able to accumulate that money for a longer time to do that. So the bank is going to give you the money. So when the bank gives you the money, which is a loan, you're expected to pay off your salary monthly for a given period of time. But you're not immortal, anything can happen. You can get involved in an accident, you can as well suffer critical illness, or you can die. Now, when you die, that's a challenge. How do you protect your family from losing the property that you have acquired? And how do you protect your family from becoming a laughing stock? Because, I mean, they were known to have that property, and then before the property is published in papers and it's going to be auctioned, and then they get to lose out. So it's quite a critical thing that we need to really look at and ensure that we are not losing out on these things at all. At this point, I think let me proceed with the other product, the annuities. And I've been talking about the annuities along the way as we've been discussing. These are insurance contracts which provide a fixed income stream for either person's lifetime or a specified time period though they have no life cover benefit. An annuity is something that you purchase. Now, when you buy a life policy, you can have a target as an annuity. And you say, by the time I retire, I'm used to a salary when I'm working. So I want to purchase an annuity so that I am able to have cash inflow monthly the way I've been used to do it. So the annuity, you come and purchase it because your policy has matured, you have received a lump sum. So you come to the insurance company, you purchase the annuity, and then you are designed a kind of payment that comes to you every month. So there are two types of annuity. The immediate annuity, where the lump sum is paid out to the insurer and converted into the guaranteed stream of income for a specified period of time or for a lifetime, and withdrawals may begin within a month. So the immediate annuity that you purchase it this week, and next month you start earning. You start earning your portion, which comes in the form of a salary. So when you have an annuity, which is paying maybe for a given number of years, talk about 10 years or so, maybe for your lifetime, you can as well go to the bank and borrow because you have a salary that is coming from an insurance company as the annuitant, and you're going to be able to pay use the part of the money to pay off your loan and also live your life well. So you can also use part of that money to purchase a life policy for probably your grandchild or your child if you got one a bit late, and the education security is also given in there. So there's what called the deferred annuity. This works in the opposite of the immediate annuity. And how does it work? You can buy it now, but you are to start getting the benefits of the annuity when you retire. So here you keep contributing money slowly by slowly, and then you build it. When now the period of retirement reaches, at that point now you start enjoying the benefits of your annuity, which come in the form of the salary defined by the providing the annuity that comes to you, and then you can. Also, when you retire, maybe you have received the money from the NSSF or any provident fund to purchase the annuity. Part of it is used to purchase the annuity. Now we have the pure investment products. There are quite a number of them. And these do not have the life cover component, but rather they are pure investment offered by insurance companies. And some of them are the unit trust funds and the personal retirement plans. Now, the unit trust funds, this is money from different investors put together and invested in a financial market through a single collective scheme called the unity trust. And I think you've heard about this. So these earn returns on a daily basis, and they earn returns on a weekly and on a monthly basis. So the return, which is annual, can be split into the 12 months and can be split into the days in a month. So every day this money is put there, it earns a return. So and they're tax exempted. So currently on the market, the returns about between 11 and 12.5% annually, and now that's what can be split across the 12 months. So your money is not redundant in terms of not making money for you, but you can always access it when there is a need. We also have the personal retirement plans. These are designed for self-employed, and they help to create an individual retirement account with the tax advantage. Under this scheme, the individual can be guided on the long-term value of this fund, which they can also use to purchase annuity, as I explained earlier, for a stream cash flow during their less active years. So you may not really be working with an organization where you have a group retirement scheme, like a provident fund. So you can buy your personal retirement plan, because you know at some point you will stop having the energy to really get involved in your daily routines, but you'll still need money. So you can purchase a personal retirement plan, and it's designed to ensure that it will meet the point of your retirement, and then you can use it accordingly. You can either receive the money in lump sum and start a project, which will create an inflow of cash every month, or you can use to purchase an annuity, and then it is managed by the insurer to ensure that you get this salary coming through every month. Then we also have the corporate products. These are various insurance products which can be taken up by corporate entities, companies, organizations, etc., for benefiting their employees. These are referred to as corporate or group products, and they can only be taken by a group of people and an organization. Some of them include the following. We have the Deposit Administration, we have the Group Life and Group Credit Assurance, among others. And if I'm to continue, I will take you through the Deposit Administration. This is a pension plan administered by the insurance company, where the pension funds accumulate in a master group provident fund until a participant retires. So you can choose as an organization to have these monies contributed. Some of them are contributory, the employee and the employer contribute towards that. And these monies are now given into the life insurance company, which becomes the administrator of that. And then they keep accumulating as you contribute every end of the month. So when you retire, the individual member, you decide what to do with this money, whether you receive it in lump sum, or you can also choose to break it up in various investment drives. So you can be able to put some in the unity trust. You can choose to put some under the annuity and take some for a project that you anticipate to build. So a member may choose to take the entire money to start a retirement income generating project, or may use the money to purchase an individual annuity from a life insurance company, and is paid a monthly portion in form of salary throughout their lives or up to a specified period. But also they can use this money and put it in the unity trust under the money markets to keep accumulating and making more money, but access it as and when there is need. Then we have the what's called the group life. The group life. This is a life insurance policy taken by an organization, which is a single contract which covers the entire group of employees in that particular organization. So the policy owner is the employer, or an entity, which is an organization or company, and this is an annual. This policy is annual and expires after 12 months. 12 months, and upon death of the employee, the employer will claim from the insurer to whom the benefits are paid and later passed on to the family of the deceased employee. Now, unlike the individual policy that I discussed earlier, here the insured is the organization. So there's no direct relationship between the insurer or the insurance company or the life insurance company and the employee, but the relationship is between your employer and the insurance company, because the employer is the direct client of the insurer. So the benefits are normally calculated in multiples of annual salaries as defined by the organization, or up to a specified period of time as can be determined by the organization. So most organizations give this as a benefit, and also to ensure that their people work knowing that they have a fallback position. The only difference is that you have no power over that. And when you move from that organization and go to another organization, that cover ceases on you. So that's how you see the importance between being an organization and you have a group life, but also purchase your individual policy, because this is your policy wherever you would go. Then you have the group credit. This is an insurance cover which offers coverage to the lender. Now that's a bank or a financial institution. And then the payout is the outstanding principal amount in the event of the death or disability of the debtor. So you know that some loans that we receive are non-secured loans. They're normally salary-based loans, and the only security is your employment. So sometimes you can die with such a loan. Some people disappear, or they completely become unemployed, maybe because of the downsizing of the organization and the like. Now, when you have such a loan that you've taken from the banker, in this regard, the Credit Life, which now the banker himself will have to take, will be able to cater for that income to avoid loss of such income, so that business continues. So the person can offer additional benefits, including the accidental death benefits, permanent disablement, and critical illness benefits. So quite a lot of things can lead to your downsides. You can die, you can suffer disability, and you cannot actually continue to work. You can get a critical illness, which will be very critical that you actually be off for a long time, and maybe the employer feels they have to replace you. But this can happen when you have already gotten a loan. And now when you have a loan, the banker here should be able to find a way of getting their monies. Now, the bank or the financial, any prudent one should be able to have the credit life insurance to ensure that they don't make losses under these circumstances. The premiums are charged normally on the basis of flat rate and related to the borrower's age. So it is just when you're employed, you just have to create a rate for that organization, and then based maybe on the risk that is there, what kind of work are you doing, and so many other things are involved in there, and then they can be able to give you that loan. The risk is the principal loan, whose face value decreases over time, and the borrower pays off the loan. This, however, does not lead to the decrease of the premium. So when the risk occurs, and you have taken a loan and you have been paying for a number of maybe years, maybe you took a loan of 4 years and you're paid maybe for 2 years, the loan will have reduced. So if you happen to die at that point, then the insurer will clear that outstanding entire loan, but the premium which you pay remains constant. So that is it with these products, and a lot of information can be shared off here, but this presentation in itself cannot actually be able to complete everything. But these are the insights that you should be able to take when you look at these particular products discussed. So what we take home from here, the greatest interest of all, Uganda Insurance Association and its members, together with the UIBS FS, should be to ensure that all Ugandans get awareness about life insurance. So we should therefore mandate ourselves to bring this awareness close to the public whenever we can. And doing this will translate into our overall mission overall missions from our institutions. So it's critical that this awareness continues, but also to those who hear and learn about these things through these webinars. Be alive, walk into an insurance company, make inquiries, go to the Uganda Insurance Association, make a call, make inquiries, find out how you can be able to make a decision if you feel you are not being able to be helped. But as people in the market are walking around, the insurance agents are walking around to talk to you about this, give them an audience, listen, ask a few questions and learn about the things, because this is a necessary requirement for every working person, because like we said, your life already started when you started working. Retirement begins the day you get your first employment, and saving should start there. Investment plans should start there, and also the future that you want to leave for your people, the legacy that you want to leave, the inheritance that you have to leave begins right at that time. So it's a great responsibility that we have to take on and ensure that we are able to stay well, to have our social lives protected, and we shine on. So basically, that's what I have for you today. Thank you so much. Probably we can now, Badru can go to the chat maybe and we see if there are questions that we need to address. Yes, I've seen. Yeah, you can now be able to lead me into the questions, Badru, please.
Yes, thank you so much, Michael Kalule, for that insightful journey into products that are provided by life insurance companies on the side of insurance products, savings, and investment. It has been quite well insightful and knowledgeable. And I think members have picked a word or two in line with understanding the product portfolios of insurance companies in the line of investment and savings as well. Maybe before we can go to the questions, there are two people who have raised their hands. Maybe can we have Nsamba Ismail to share a question with us before we can go to those which have been posted in the chat? Nsamba, can you be able to put out your question? Okay, Catherine Nasulumbi, you've raised up your hand. Can you be able to put out your question for the speaker? Okay, Nsamba, I see you've unmuted. Can you be able to put out your question or comment quickly? Okay, I think maybe they are not there. We shall go straight away to the chat. We've received 3 questions. If we can begin with one of David. David says, what happens to my savings if an insurance company is closed? That's one question. And then the other one, he adds that, why is it that when one wants to access the savings, earlier than the agreed term, money is always reduced. I think those are two pertinent questions that Mr. Kauli can address for the interest of our members. One is we hear insurance companies might close. What if a company closes and I've already put in my money? And then secondly is why is it that when I want to access my money earlier than the agreed period, I always get less. I think it's referring to what many people call the surrender value. Why is it that it's always less? Maybe you can throw more light as we go to the other question.
Thank you so much, Badru, and thank you so much for the questions. You know, an insurance company may not necessarily close like overnight. You wake up and it has closed. Remember, the licensing of insurance companies done annually after the thorough analysis and scrutiny done by the regulator. And if they find that the insurance company is no longer healthy enough to keep on taking on lives or to give cover to people, they'll have to stop it from operating in that line, but they'll have to inform the public of the offer, or rather of how they can be able to recover some of the money that they have under that policy. So that's the reason why the regulator is there. That's why every insurance company has got it should be able to, or is obliged to have a security that they put it up with a regulator. So if this happens and the insurance company closes, the people who are insured in there's a portion of money that goes back to them, and that actually can be this information can be accessed through the association. How much can it be? What rates are looked at? But you don't lose out your money completely. And also, you can't simply wake up and realize tomorrow that this life company so and so closed last night. No, the closure of insurance company is not just like that. There must be publication that this company want to continue to operate, and then the guides are given to those people who have insurance covers with them, with that insurance company, and then the procedures on how they can be able to recover part of the money. Of course, they won't recover all the money, I believe, but there's a great portion that you have to recover, and that can actually be picked up when you now visit the UIA and get that information. For those who, there's another question which was also saying that, what if, when I want to recover, I think I got it right that my policy is running and I want to get my money a bit earlier than the anticipated period. Why does it always, why is the money always less? Remember, when you take up a policy of insurance, one, you have to know that it is a contract, and every term in the contract is well defined, that the policy you've taken is for 10 years. That you are going to pay a certain premium X for that period of time. And the obligations are well defined both for the insurer and the insured, the person who has taken up the policy and the company which is offering the life cover. Now, if you happen to cancel the policy prior to the maturity of that period, there are so many losses that the company has already made. Remember, if you look at the, when I was trying to show you what the Uganda Insurance Association do, the intention is to ensure that there is awareness and expansion of insurance and reinsurance services in the country. Now, the reinsurer which you saw there is one of the people who are working together with the insurance company to take on the risks that are available. So any money that have gone there may not be able to return. The contract that we have signed have got a lot of expenses that come with it. So all these monies are lost the moment you cancel the contract. So the money which you receive, probably it's a surrender value that you receive, will be less those expenses that were not anticipated. Because when you take up a policy, our anticipation as insurers is that you leave your policy up the end of the policy term. And most of the policy documents that you carry will have an explanation and the repercussions for any policy contract that is cancelled before its due date reaches. So this is expected, just like any contract that you want to cancel, which is a bit financial, and because there are expenses incurred by the provider of insurance along the way. Now, when you cancel, they will not be recoverable. So in that regard, you cannot be able to receive 100% of this money. Thank you so much. Any other questions, please?
Thank you, Michael, for that elaborate answer. Maybe also to respond to David Kayemba, the insurance industry is well regulated, and we are working in a good and a well-regulated framework, which is in place to measure how much risk that we are handling as insurance companies. And at any time, we are monitored by the regulator, and if there are any chances of having our exposures as being higher than what we have as assets, then we are notified and we are advised on the way forward. So there shouldn't be any need to have you be worried about the fact that the company can close maybe overnight. And I think this is public knowledge. You know, one of our member AIG is leaving, but there hasn't been any problem with the public concerning the products that they already have with that company which is leaving. So it's all regulated, and if there's in any event that the company is leaving, there is a good transition through which policies are moved on to another member. And also you have to note that the members' monies and savings and the insurance deposits are also backed up by assets that are monitored by IRA and Bank of Uganda. Maybe on the other question, related question concerning someone receiving less than what he has put in, there is one who is, I think Priska is asking that I was saving with one of the two companies. I was saving with a particular company, and for the last 2 years, I've not been able to save. And when I wanted to resume, they told me that I have to first clear the amount in total, and I didn't pay for the last 2 years. Maybe you can just clarify on what that could mean, and why he was told that he has to first clear the areas before he could move on.
Okay. Now you realize that first of all, most life insurance companies will give an option or will give alternatives to a client who started up the contract. Maybe there was loss of employment, and then so the person goes into what called a lapse session status, where it becomes inactive and therefore cannot be able to pay out their benefits if a risk occurs. Now, a client would come back after getting back to employment and they want to continue with their policy. So there are two scenarios. The client may stick to the period of insurance that they took. They say, my policy is maturing in 2025 and I want it to mature at that time. So if that's the case, then the client, Badru, can you hear me well?
Yes, I can hear you. You are breaking, but I think now you can be heard well.
Okay, I was saying that if a client has taken up a policy, I'm going to use an example, a policy of 10 years, okay? And when they now fall out of employment, they're unable to work. Maybe they have been downsized. Look at the scenario of COVID where a lot of employment have been lost. So they stay without employment for, let's say, 2 years. Now they return when their policies are already lapsed and they would like to continue to resume with their policies. Now, when they return, they may want to stick to their original policy that was probably maturing in 2025, and they wouldn't want the maturity date to be altered with. Now, under such circumstance, a client therefore must pay all the outstanding premiums for the 2 years that they were not contributing the premium. But if a client realizes that maybe they are not to have this money, to raise this money, now this policy can be redated. In redating, we mean that we extend the maturity date 2 years beyond the actual maturity date that was defined in the policy. For example, if it was to mature in 2025 and you have outstanding of 2 years, which you cannot be able to pay, then we extend the maturity date to 2027, and then you continue at that time. So those are the alternatives that can happen. So if a company says you have to pay all the outstanding, presumably you have stuck to the period of assurance that you picked up at the inception, and you don't want that to be altered with, so the insurer will require you to pay all the outstanding. But if that's not the case, then the policy can be redated, and then your maturity date is extended, so the outstanding premiums are not required. You start at that point and you continue. Basically, that's the approach. I hope I've answered that clearly.
Yeah, thank you, Michael. I think that has been well answered. Maybe if we can briefly go through these two remaining questions. One, Fiona Mages asked that education policies, how does the policy respond when after 10 years, when after my 10-year tenure of policy, my child has completed school and yet I didn't die or suffer any critical illness or PTD, will I recover the monies saved for the 10 years plus interest?
Okay, thank you so much, Fiona, for this question. Now, when you take an education policy, first of all, you should be able to know that when you take an education policy, it is a target policy. What am I meaning? You take it for a given education level that you are anticipating. Let's say your child right now is in primary 1, and you are able to pay school fees all through primary and all through secondary, and you are targeting the university, and you're saying that by the time my child reaches university, I wouldn't want to be bothered with tuition. So you buy an education policy, which will coincide with when your child is going to join a university or tertiary institution education. Now, at that time, the insurer starts paying tuition in the under the terms agreed upon in the policy and will be defined in the policy. So when you ask that if my child completes school, it means you never claimed, for example, you never claimed that you should receive these school fees because that was the reason why you're paying. So if you never claimed and maybe you got somebody who sponsored the free school fees and the person has reached now, this money must still be paid to you. So you still will receive this money because these education policies, there's no losing of money. Whether, for example, if a child dies prior to policy maturity, you can cancel the policy for your own, or turn it into your own use. If the policy reaches and the child probably has got a sponsor, like now your question probably is referring, this money now comes back to you, or you can nominate another child to whom this money can go to at the same level of education. So there's no loss of monies whatsoever.
Okay, thank you, Michael. Maybe also if you can just add on, someone is asking that at the end of the policy term, will the insurance company, if I have an education policy, will the insurance company pay cash, or would the insurance company take up the burden of paying tuition for my child? Maybe if you can just also clarify.
Okay. When you take up a policy, education policy, for example, in that regard, and the time for paying comes through, the choice lies in the hands of the parent or the guardian. You can instruct us to pay directly to the school, or we can pay to you because you know the use of the money, and then you pay. For example, the portion that you are receiving that term could be much more than what the school fees requirement is. And maybe you are receiving 6 million shillings and the child requires only 2 million shillings for that particular term. So we can't pay all that money to the school. So we'd rather pay the money to you. You take up a portion of 2 million for that particular term, and then the rest of the money you can use for other things. Some people use it to buy insurance policies for their other children who were not covered by the time they were taking the first policy, or they buy their own policies for retirement and the like. So the choice is normally on the client. The client can say, pay so much to the school and then pay so much to me, and they provide both account details, and that's what we shall do, please. Thank you.
Thank you, Michael, for that good answer. And then we have one last one, which is seeking about clarity on how annuities operate. Maybe you can have that answered, and maybe at the end you can share your contact for maybe further inquiries. So you can answer that as you wrap up, and then I'll come in to do the final and the closing remark.
Okay. Annuity, I think I want to go back a bit on the earlier slide that I provided. Maybe we can be able to let me just explain, because maybe you will hear more without looking at the details. An annuity is something is a fund that is created with an insurance company for you to continue earning as if you're still employed. For example, if you retire today and probably receive a lump sum of your provident fund or NSSF monies, you can come to the insurance company and purchase the annuity. The insurance company will compute for you how much money you're going to be receiving every month, either for a specified period of time, which you may choose, or as long as you live. Now, whatever you choose, either of the two specified period of time or as long as you live, now will determine how much money is going to come to you every month. And this comes in the form of a salary. Now, when this happens, it can be immediate that you want it to be starting next month. So you start earning this money. Let me take an example for the rest of your life. You start earning this money every month, this check is paid onto your account like a salary every month, as long as you live until, even if you outlive that money which you got as a lump sum, maybe you got 200 million to ICEA, and when you bring every month, so you live for so many months, so many years, I would say. I want to take a simple calculation here. 200 million shillings divided by 1 million, maybe you're going to earn this money for 200 months. Now you live, 200 months is about 16 years. So you live more 20 years, meaning there's 4 years which you never paid for. Regardless of that, you will still be earning this regular payment monthly. So that's how annuities work. You cannot come and purchase an immediate annuity with an initial premium. No, you purchase it with a lump sum. But when you want to build your annuity with an insurance company, or we call it a deferred annuity, which you will earn at a later stage, maybe after 10 years. Now you can now be able to purchase a deferred annuity where you are not going to be paid immediately. We create a fund for you either through the unit trust, and then you keep depositing that money there. As you accumulate a certain amount of money, maybe it reaches 100 million, and at that point you have attained the retirement age, and then you've got some other monies in terms of the Provident Fund or NSSF, you put in there, and then you know that I would like to be earning monthly. So we compute a payment that will be coming to you directly on your account every month, just like any salary. Just like I also say, a person, the annuitant is the person who has an annuity with an insurance company, can also borrow using that money because it is a regular income flowing in every month. So you can also borrow from the bank, and the bank will deduct off that money, which you receive like a salary, and then you run your life normally. So that's how really annuities operate.
Thank you so much, Michael. I think that was well understood. I don't know if we have any other question from the participants. If there are no questions from the participant, maybe you can give us your parting shots, maybe share your contacts. In the event that someone wants further clarification, then I come in just to close the webinar.
Maybe I can share my contact. Is that what you're saying?
Yeah, maybe, yeah, there could be 1 or 2 people who would want to get further clarification on 1 or 2.
Thank you so much. I have one number. It is 0782 914-630. I want to repeat it. 0782 91 46 30. That's my number. 0782 914 630. So please, if you need to contact me for clarity on any of the products I've talked about, maybe probably on any other life insurance knowledge that you'd like to, or information that you'd like to get, that's the contact. It's both on call and also on WhatsApp. You can be able to reach me on that. Thank you so much.
Thank you so much, Michael, and thank you for your time, and as well as the participants. Thank you so much for being a good audience and taking off this wonderful time of your busy schedules to understand more about insurance and how you can do savings as well as investment in insurance companies. We at Uganda Insurance Association, we are delighted to be part of this. And as you can see on your screen there, those are our contacts and and email addresses in the event that you'd want to know anything about insurance, or in the event that you'd want to have clarity on your insurance contract, or in the event that you have challenges with any insurance company. We are ready and willing to help you out to address any of those challenges. Once again, let us thank our good sponsors who have been part of this webinar since it began at the beginning of the week. That's Housing Finance Bank, Equity Bank, Finance Trust Bank, DFCU Bank, Citibank, KCB, the Financial Intelligence Authority, Absa Bank, Mercantile Bank, Exim, Finca, NCBA Bank, Ugaford, BRAC, Bank of Africa, DCB, Capital Bank, and Tropical Bank, as well as Cairo and Baroda Bank. We thank you so much. Thank you so much for being part of us into this journey of financial awareness. We also would like to thank our other stakeholders. That is Capital Markets Authority, East Africa, the Uganda Retirement Benefits Regulatory Authority, UBRA, Uganda Microfinance Regulatory Authority, and us, Uganda Insurers Association, in the collaborations that we have into the second webinar series about financial awareness. Please, members, note that there will be another session at 6 p.m. Under the topic setting realistic goals. Setting realistic retirement goals. This will be hosted by Joanne Mugenzi, informational coach. She's also the author of the transformational coach and author of the book. The transformational coach and author of the book Operates Crossroads. It's going to be an insightful session. Please join in. Don't forget, join in at 7:30. Just before you close out, in our last session of poll questions that have been displayed over there for us to take note of what thank you so much, participants. There is our poll results. Thank you so much for rating this webinar. Most of you concur it was good, and the proportion was also well arranged. We appreciate. Up to time you've dedicated for this webinar, and once again we call on you to be part of our other webinars, especially one also be part of future and financial awareness and thank you so much for putting aside this time for this series of webinars. Which largely fits into what has been talked about providers. Thank you so much. Uganda Institute for hosting this. I congratulate all of you for being part of this webinar. Until when we meet again at 6 p.m. Thank you so much.
Lead me where my trust is without borders. Let me walk upon the waters wherever you would call me. Take me deeper than my feet could ever wander, and my faith would be made stronger in the presence of my Savior. Spirit, lead me where my trust is without borders. Let me walk upon the waters wherever you would call me. trust is without borders. Let me walk upon the waters wherever you would call me. Take me deeper than my feet could ever wander, and my faith will be made stronger in the presence of my Savior. Spirit, lead me where my trust is without borders. Let me walk upon the waters wherever you would call me. Take me deeper than